Hi, I've called today's show Confessions of a Real Estate Entrepreneur. So if you want to become more successful in life, in business, in property investing, you're going to get a lot out of this show, because even if you're not an entrepreneur in the sense you think about, if you want to be different to the average Australian, if you want to get further, you are going to have to be entrepreneurial. Boy, have I got some interesting content for you today. So welcome to this week's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator, who has once again been voted our leading expert in wealth creation. That's the fifth time he's won a similar award in the last 7 years.
Hi and welcome to my first podcast for 2019. I've called this show Confessions of a Real Estate Entrepreneur because the microphone has been tipped and Brett Warren's taken over and going to be interviewing me and asking me a lot of questions that have been left on the website by readers of my blog, listeners to my podcast, and he's actually added a couple of questions of his own as well. Why? Not because I'm being so vain and I want to tell you all about me, because boy have I had my share of failures, but because I find it instructive hearing and listening and reading how other people have achieved their successes and also learn from the things that they've done wrong. So we're pulling behind the curtains, and you're going to see a little bit about my journey as a business person, as an entrepreneur, and as a property investor, because this show is dedicated to helping you become more successful in property, in business, in life, in success, and money. So I hope you're going to get some great lessons from it. I also want to share a lesson with you about gratitude, because it's the beginning of the new year, and it's a time I try and appreciate all the good that's occurred to me in my life, especially over the last year. It's too easy to take it all for granted, to take too many people for granted, to be too busy to even think about it. Interestingly, by the time you listen to this, I'm already going to have been on a plane and on another continent taking an extended vacation with my wife, Pam. We're going to be spending close to 7 weeks in Europe, mainly in Italy. But don't worry, my daily blog's still going to go out thanks to the wonder of technology. Actually, that's one of the other things I take for granted, isn't it? And the podcast is going to be coming out every week as well, because I've pre-recorded them, so not just rehashes of old ones. By the way, this vacation time is a really good time to listen to all the old podcasts. Listen at 1.5 times speed if you like, but why not go download them and have a binge? So I've got a special show for you today. It'll teach you some of the benefits of having mentors and listening to or reading people's biography. But back to what I was saying a moment ago. It's a time to feel grateful and to be thankful, because there's a veritable army of people working for my benefit every day. Some of them I know, and some of them know me, and there's others that I don't know, like the men and women in the Australian military putting life and limb at risk in places and situations I'd never even go to. So I can sit here comfortably and put together this podcast. Or I can write my blogs and I can express my opinions freely and without demand that I adopt a particular religion or a way of thinking, and if I wouldn't be it, then I'd be beheaded. Look, I live in a relatively safe country, a very safe country, because of our police force. I've got a safe and secure environment because of our politicians. Like them or hate them, they're still a much better place to be here than anywhere else. And, I can assist my clients all around the world because of the internet, and I can freely pass on education to you through my podcast, to readers of my blogs, to readers of my books. Closer, if I'm wanting to give gratitude, there's Pam, an indispensable, important mate in my life, and my business partner and partner in life. Now, I've been able to create all this, my podcast, my newsletter, the Metropole group of companies, and my own substantial property portfolio, and this wealth has come because of all sorts of people working for and with me. Not simply because of my own ambition, ability and fortitude, but because of theirs as well. These include those who work and have worked in the trenches at Metropole, and our many professional alliances that I'm so appreciative of. And there's the people I've been fortunate to find, I've been able to trust and delegate to for years, even decades. Look, in a funny way, I'm even grateful to that handful of people who've been thorns in my side because they've been motivational forces. Boy, have I had difficult times, and I've also had people who, that tall poppy syndrome, who've tried to knock me, who've tried to pull me down, who've tried to give me a hard time. Here's a little secret. Very few achievers are there by positive influence alone. Successful achievers actually have negative influences like I've had over my life, people who've given me a hard time, had a go at me, and it's actually turned and made me twist things around and channeled the resentment, the anger, the redemptive desire, the vengeful spirit, the dark experience, and I've channeled it into power instead. That's a big difference between the successful and the average person. And I especially feel grateful to you, the listeners of my podcast. Thank you. And to the 115,000 odd subscribers to my newsletter, and the smaller number who get my daily newsletter. By the way, if you don't get it, go to propertyupdate.com.au and subscribe to that as well. Performance isn't possible in an empty theatre. So what a privilege it is that I have, what a privilege to have a large and ever-growing number of people with sustained and enduring interest in what I do, what I have to say, and what I teach. I know some of you have been with me for a decade, others for up to 2 decades. And I can't tell you enough, or often enough, how much I appreciate you. I respect you. And boy, do I wish you success. So whether you're a property investor, a business owner, an entrepreneur, without you, this entire economy grinds to a halt. We're all, as that famous playwright describes us, often out there, way out there, with little more than a smile and a shoe shine, creating, making things happening, morphing ambition and determination into the fuel of everybody's engine and food for everybody's table. If you're an investor, if you're an entrepreneur, if you're a business person, if you're a professional, you're grossly underappreciated by most, but not by me. I believe there should be a mandatory class in every high school called Gratitude for Those Who Pay the Bills and Provide the Jobs. Many Australians are utterly ignorant of the fact that our system's actually an upside-down pyramid. The few congregated in the tiny point shouldering and supporting the big, broad, heavy base. Most of them look at this upright pyramid with few lords at the top and beaten, whipped and downtrodden masses at the bottom and ask our government to change the system. I know better, and so do you. We know what it's taken to get to the top, and rather than bring everybody down to the bottom to even things out, I try and do it another way. I try and express my gratitude and bring people up through my podcast, through my blogs, because I'd like to level the playing system by bringing them up, not by bringing everyone down. So on behalf of those who don't understand, I'll say their thank you for you. They won't, so I will. Now, 2018 has been a great year for me personally and professionally. I wish you a happy new year and a healthy and prosperous 2019, and I look forward to joining you once a week with this podcast, and for most of you, once a day with my daily blog and property update. So let's get on with today's show, which is a bit longer than normal, but if you're on vacation like a lot of us are, I hope you'll have time to enjoy it, at the end of which I hope you're going to learn some new things about property, success and money.
Hi, this is Brett Warren, and today I'm turning the tables on Michael Yardney and grabbing the podcast microphone. Michael is the Director of Metropole Property Strategists. Many consider Michael to be Australia's leading authority on wealth creation through property, and in fact he's been voted Australia's leading property investment advisor 4 times in the last 6 years. So I thought it would be a good idea to pick his brains and see what we can learn from a very successful property investor. Hi Michael, and thanks for letting me take over your microphone.
It's a little bit different being on the other side, but that's okay. I know people often write in questions about property topics, but a lot of ask questions about me. So I know you've gathered them all together and tried to put them into one show. So let's see how it goes.
Absolutely. Hey, let's start from the beginning, Michael. Why did you get involved in property investment?
Well, Brett, I came from a poor family, and my family struggled each month to make ends meet. I knew no different. I mean, I never went totally without, but I remember my parents arguing, struggling, deciding which bills would get paid and which wouldn't. And as a young boy, and I don't remember how young I was at the time, I decided I wasn't going to do the same. I decided I wanted to get rich. Interestingly, the first really wealthy people, or I thought were wealthy, I came across were real estate agents. I remember when I was 9, my parents eventually bought their first home, and I can remember being really impressed with one particular agent who drove a big American car. That was before the BMWs and the Mercedes were the luxury cars. And this was in the 60s, and the big American Yank tanks, they were expensive, they were imported. Very different from the Australian cars we had. Oh, this estate agent, he impressed me. And I thought, that's what I want to be. Look, later on I realised, Brett, that it wasn't the estate agents who were wealthy, it was the people that they were working for, the landowners, the property owners that were wealthy.
What was your first investment property, Michael, and what did you have to do to get it?
Well, I bought my first investment property when I was in my 20s. Now, over the previous years, I'd been working while I was at university in Portman's, the fashion store. It's actually interesting. They're still there, the ladies' fashion store. I was in the stock room. I was picking stock and putting them on pallets, on racks for them to take out to the stores. And I saved up, and I somehow or other got a bank deposit. I got a bit of a personal loan as well. I got about $2,000 deposit, but it wasn't enough. So I actually went halves with my parents and started looking around for properties. And I found one in a couple of days. And I got all excited, and I put an offer in before the auction, and we paid $18,000 for a property in Larch Street, South Caulfield. In fact, I went halves with my parents, as I said, because I couldn't afford the whole lot. Now, in retrospect, I guess I probably paid too much because the offer was accepted before auction. Oh, look, I made lots of other mistakes as well. It was one of the first properties I saw. I got emotionally involved. It was right around the corner from where I went to school, all the areas I knew. We got $12 a week rent. I was actually very excited by all that.
What actually happened with that property, Michael?
Well, Gough Whitlam came into power. The Labor Party came into power, which is actually very telling with what's happening in the Australian political surroundings at the moment. And the end result was we had massive inflation, and that property went up in value so much that I actually had enough equity to draw down and buy a second one in Bond Street, Caulfield. Now, a few years later, I got married, so I sold that property for my half share of $32,000. I sold it to my parents, $18,000 to $32,000. I bought it back from my mother, Pam, and I bought it back from my mother in early 2000s for $260,000, and we've since built 2 townhouses on it. So my first property that cost me $18,000, I still have now, with a big gap in the middle, and it's worth well over $2 million, Brett.
Well, that's a fantastic story. You obviously enjoy what you do as well. What do you love so much about property?
Well, over the years, I've realised that property lets me have all the essentials of what's a great business. If you can do things right, you can get good cash flow, but you can add value to your properties. So I've learned how I can manufacture capital growth. And if you take a long-term view, if you buy the right property, you're going to build a very substantial asset base. The other thing I personally like about property is the creative side. I, as you know, get involved in property development, so I build new properties. It gives me pleasure. I like driving down the street and seeing the end result. But I think the thing I like most about property, Brett, is the flexibility. I can choose the level I want to play at and how much I want to play with and who I want to play with and where I want to play. I can operate anywhere in Australia. No, I guess I can operate anywhere in the world, but I've chosen just to stick to Australia. I can do as little or as much work as I want by employing the right people to do things that I don't want to do.
Great. There's a lot of talk around, obviously, when people are first starting out about the positive versus negative gearing. What's your take on that argument, Michael?
Well, first of all, positive gearing, negative gearing isn't even an investment strategy. It's the result of the type of property you buy and how you finance it. In my mind, in Australia, residential real estate's a high growth, relatively low yield investment. So if you buy well located properties, they tend to have good capital growth, but poor cash flow. And the properties offering good cash flow, or better cash flow, they tend to be in those areas which haven't got as much growth. They're secondary properties. They're not as good location. Now, I can understand why many beginning investors want to get involved in positive cash flow properties. They think they're easier to buy. They think the servicing of the loans are easier. They don't have to put their hand in their pocket every month. They think what they need is income. Look, and in general, they do need income, but that's not the way property works. What they need, in my mind, is to build an asset base first. then transition to the cash flow stage. So what most investors don't realise is that most of those areas in the secondary locations in regional Australia are experiencing minimal growth. Now, I know some regional areas are doing reasonably nicely at the moment, but overall, they're not getting the population growth. They're not getting the multiple growth drivers that the big capital cities have. And so some of those people who buy in these regional areas, while in the short term at the moment, they're doing reasonably well. In the long term, they're going to have tenant problems as the population in these areas dwindles a bit. They find when they have property problems, there's repairs are more expensive because of lack of tradespeople. In my mind, you've got to invest for capital growth. Well, initially anyway, until you build enough asset base. If you want cash flow, don't buy real estate.
Okay, great. What do you mean there are other ways to get money out of property, Michael?
Well, I think there's a number of ways people get money out of property, and most people don't realise that there are 4 ways.
Okay, what are those 4 ways?
Well, okay, the first one's rental return, and that's the rent that you get in. You get your profits from the rent coming in every month. The other is what we spoke about a moment ago, I guess, this passive appreciation. The property goes up in line with the general market, if you've got a good property. And our statistics go back 25 years at Metropole, and you and I know that Brisbane has done, on average, about 7%, Melbourne and Sydney about 8% over 25 years. So property values, good properties, have gone up and doubled every close to 10 years. Sure, lots haven't, but the average property hasn't, but well-located ones has done well. Then there's active appreciation. So there's passive appreciation, just the market doing it. And in my mind, I like the active appreciation when you add value by, well, you can even start by buying well and getting a good deal, but that's a one-off, but also by doing value add through renovations or development. And then there's the tax benefits as well. Now, some investors buy for cash flow, some buy for capital growth. In my mind, if you get a blend of all those 4 things, the rental return, good appreciation, the ability to add value because you bought a property with a twist, tax benefits, all those things together, I think that makes a good investment, Brett.
Okay, interesting. Do you recommend people look for property anywhere in Australia or just focus on specific areas?
Well, I guess the first thing is don't concentrate on your backyard. If you do, you're likely to miss some great opportunities unless you're in that right location. So I don't suggest anywhere because we've found that the majority of the economic growth, see, we look forward. We want to see what the sort of property is going to be in strong demand in the future is going to be. The majority of the economic growth happens in our capital cities. It's different to the past. Sure, jobs are being created in regional locations, but they tend to be part-time or seasonal because of the sort of industries that are there. So the majority of the work's happening in the capital cities. The majority of the new jobs are happening in the East Coast capital cities, Melbourne, Sydney, Brisbane, and then in particular locations in those capital cities. So I would only be investing in the East Coast, in the big capital cities, and if you're not in those locations or you don't know them well, then use somebody to help you on your side to get to know them. So just because you know the local area because you live in it doesn't mean you understand how the property market works. Understanding your neighbourhood isn't understanding the economics, the finances, the intricacies of the property market, Brett.
Yeah, I think that's an interesting point. You don't have to know exactly what you're doing. There's other people who specialise in these areas and they're often the best person to turn to.
Makes sense.
When do you think is the best time for someone to start investing in property, Michael?
Oh, look, there's that old Chinese saying that says, when's the best time to plant a tree? 20 years ago. And when's the second best time to plant the tree today? So look, Brett, who wouldn't have liked to buy the property their parents bought for the price their parents paid 20 years ago? Anyway, I think currently there are some great opportunities to start investing in Australia. Look, we've moved to the next stage of the property cycle where there's going to be less frenetic competition. Things are a bit slower. There's uncertainty in the world of finance, in the world of banking, in the political environment, in the world environment. So I believe while other people are sitting on the sidelines waiting for all this to clear, it's a good time. Look, you've known me long enough. We've been working together for over 11 years. You also know that I think there's always a good time. And people say, oh, Michael, you're an internal optimist. No, I'm actually a realist. So there's always a good time. What will vary, though, is where you buy, what you buy, how you finance it. But there are always good opportunities. So the right time, if it's for your home, is when it suits your family. And if it's as an investment, Brett, it's really when you've got the right finance to do it. So I think this slower market where it's a buyer's market, where you aren't going to have as much competition in Melbourne and Sydney. I know Brisbane's actually done the opposite and it's starting to heat up a little bit now, but this quieter time is an opportunity that we haven't had for quite a number of years. So it's going to, if it's the same as every other cycle, we're going to have a period of slower growth, but it's going to set up the stage for the next big property boom. And the next one will do well again because the underlying fundamentals of strong population growth, a reasonably strong economy, more people coming in at household formation age, the fact that our population is going to double in the next 40 maybe 50 years, all that's going to mean that get in now, in 20 years' time, when you look back, just like we said a moment ago about that the Chinese saying, you're going to look back and say, boy, I should have bought then. I know I'm looking at the moment personally, and so are you.
Yeah, absolutely. Look, what type of property are you currently investing in and why?
Okay, well, I'm different, I guess, to most. And I know people love to know what I'm up to. I've got a very large portfolio, and it consists of residential property, but I also have commercial, retail, and industrial. But personally, I'm currently seeing the best opportunities in residential real estate, and I'm personally investing in properties with development potential. So my strategy is I buy old rundown houses close to land value in the middle ring suburbs of our capital cities. And then I add value by adding a development approval and then build townhouse complexes of 2, 3, 4, 5 on a block. At the moment, I'm involved in 4 developments, each of 2 townhouses only. And then I personally keep them as long-term investments. So in the past, I've looked at older apartments with renovation potential, complete blocks of apartments. Where I am now, I don't buy individual apartments anymore. But the best bang for bucks at the moment is buying old properties close to land value and adding value through just putting new properties on townhouses, which are the preferred style of accommodation for a much larger percentage of the population nowadays, Brett.
Okay, and why are you investing in this type of property?
Well, a couple of reasons, I guess. I've sort of said it now. I can add value. I can manufacture my own capital growth. So at a period of time where the market isn't going to go up as much, and we know that we've got a period of lower inflation, period of lower wages growth, a period of more difficulty getting finance, I'm not counting on the market to do the heavy lifting. What I'm doing is manufacturing my capital growth. By developing the townhouses, I'm building new properties, so I'm getting great depreciation benefits. I'm getting a much better return because the tenant doesn't know I'm buying them at wholesale. Look, by wholesale, I basically mean I'm making the developer's margin, so I don't have to pay the full retail price, but they're still paying me the retail rent, so I'm getting better yields, great depreciation allowance. So I've got high growth, but interestingly, high cash flow properties, especially with the depreciation allowance. So I've really got the best of both worlds. I'm getting this sort of property that's going to be in strong demand by owner-occupiers and tenants in the long term. And I'm getting them at, 15, 18% discount to true market value. So why wouldn't I keep doing this, Brett?
Yeah, that makes sense. Are there any particular areas you really like investing?
Well, I like buying in suburbs that are going through gentrification, through transformation. In the last 20 years, it tended to be more the inner ring suburbs of our capital cities, the old industrial areas that became gentrified. And now in Sydney, Melbourne, Brisbane, it really tends to be the middle ring suburbs, those older suburbs that are a bit run down, but because of their proximity to the lifestyle, the transport, the good schools, catchments, all those things mean that sometimes the houses have gone past their use-by date and it's the land that's so valuable. So I look for old houses, areas where old houses are being done up, where people are renovating, where there's people with a high disposable income, people who can afford to and prepare to buy new houses, pull down old houses to build homes, buy new townhouses. So I'm playing not just the property market cycle, Brett, but the cycle of the suburb, because suburbs have their own cycles too.
Okay, great. And do you recommend old or new properties? I know it's a question I get asked a lot.
Sure. Well, look, both type of properties have got their advantages and their drawbacks. I guess it comes down to your investment strategy. Look, I've been spoiled. I like new properties, but I don't want to pay the premium to get them. So as I've just said, I develop my own properties, and that's something I recommend to experienced investors. New properties are, of course, more appealing to tenants and owner-occupiers. As I said, they've got higher rents, they've got depreciation allowance, good tax allowances. But in general, not always, they come with lower maintenance costs, and it'll be a long time before they become obsolete. So no argument that new properties are good. On the other hand, though, they usually come at a cost where you pay such a premium for them when you're buying investor stock from the average developer that you're not going to get capital growth or rental growth for 5, sometimes 10 years. So if you're going to buy these and you're not going to get capital growth, which is the purpose of buying an investment, then why do it? So for most investors, but just to make it clear, the premium is made up of the developer's margin, the marketing costs, the agent's commission, all those glossy brochures, the full page ads in the Saturday papers. So if you're not able to develop properties like I do, like I said I do, I suggested what we should actually do is one of two things. Either use Metropol's development services and let us help you become a property developer from concept to completion. I know we buy the sites, we do the feasibilities, we find something that's going to work and stack up and put a tenant in. We run it through development approval for council and run the whole project from concept to completion. But that doesn't suit everybody. It doesn't suit some people's budgets. It doesn't suit some people's dispositions. And that's why I then think buying established properties and renovating them, adding value would work. So in Brisbane, we don't buy apartments, we buy houses. I think that's the best investment because there's just too much of an oversupply of apartments in Brisbane. But in Melbourne, we tend to buy villa units, which have a land component. In Sydney, where more and more people are buying apartments and living in apartments, and there isn't the oversupply of apartments. So there's definitely room for established properties, but particularly if you can add some value, I think that gives you that little cream on the top, Brett.
Yeah, great. And look, Michael, you've worked with a lot of successful investors and mentored probably even more. What do you think are the essential qualities of a successful property investor?
Well, I think one of the big differences I see between good investors and those who don't succeed as well is that good investors are able to see the big picture. They buy properties for long-term capital growth. Rather than thinking about finance to buy properties, they think the other way around. They're using their properties as a means to get finance by borrowing against the increasing value of the property. They use the finance to fund their lifestyle. I know finance is a bit difficult at the moment, the world of finance, but in general, investors who don't do well tend to be more focused on short-term issues such as, is the interest rates going to go up or down? Is the government going to change? Are they going to change the land tax, the negative gearing regime? What's going to happen to the latest thing? They chase the latest fad. Is this going to work now? Rather than successful investors look at things that have always worked. They don't chase the latest fad. They look at the big picture. They want to see something. They've got the ability to delay gratification and see what's going to be a good investment in 10 years' time. While beginning investors often seem to come with a bit of a trading philosophy. I'll get in, I'll get out, I'll flip. They see this on the block. They want to sell as soon as they make a profit. Again, they don't see the big picture, that property is a great investment and you don't have to sell to be able to get money out as opposed to other investments. You just, when the ability allows you, you refinance your properties.
Okay, great. And look, since you're such a successful property investor, I know many people ask me, why do you still work? You do the seminars, the books, you still see clients. What drives you?
Look, people ask me that too. Why are you still working? Well, the answer really is, Brett, first of all, as you know, I'm not really seeing many clients anymore. There's just a small group of clients, or those in my mentorship program or been to Wealth Retreat. But the real answer, Brett, is because I really enjoy what I'm doing. You're right. I've built a substantial property portfolio, and yes, I am financially independent, and it means I don't have to work again. But I've actually never considered retiring either. To me, retiring it's a middle-class concept. A lot of people say, why do you continue working now that your candles cost more than your birthday cake? And my answer is, because everybody needs four things. Everybody needs something to do. Everybody needs somebody to love. Everybody needs somebody to believe in and something to hope for. How many rich people have you seen retire, Brett? They continue on, whether it's the Warren Buffetts of this world or whoever, Harry Triguboffs. They don't consider retiring. What I'm doing, look, I don't consider it as work. It's rewarding. It's stimulating. I do it for free, but I wouldn't tell my clients that because I love what I'm doing. But as a result of my financial independence, I can actually be fussy about what I do. I can be fussy about when I do it. And I still get a great challenge about doing what I do. I find it rewarding. Now, having said that, I don't work 5 days a week. I haven't done that for a long time. You know that. I'm actually at home at the moment while you're in the offices in Brisbane recording this podcast. Pam and I take a lot of time off. We have long weekends off. We go on our long vacations. So I've got myself a pretty good balance.
Great. Look, I know you've learned a lot of lessons and you've shared so many. What would you put down as the single most important lesson you've learned about property investing?
Look, maybe over the years, I've seen investors, I've seen them chase fads. In the old days, it was timeshare investments. It was off-the-plan investments. It was go to regional properties. It was to buy properties with options, buy New Zealand. It's been USA properties. It's been back again, off again. They're talking about buying USA properties again. Investors get bored with the simplicity of buying well-located, good investment grade properties and then letting leverage, compounding and time work their magic. The problem is most investors don't do well chasing the latest fad or the next big thing or looking for the next growth area. I guess the lesson I've learned is that investors who've been the most successful in the long term and have done so safely without speculating, the ones who bought quality properties in good locations and just allowed them to grow. So the lesson is have a plan, have a strategy, stick to the strategy. This takes the emotion out of your investing. It may make the investing boring, but it makes your life exciting. As I've often said, my investment philosophy is too simple for many intelligent people. They think there's got to be more to it. And no, there isn't, Brett. That's it.
Yeah, makes sense. Michael, one thing I've really learned off you is the motivation and mindset. I know you've widely written about this. When did you learn the importance of the mindset and motivation?
When I first started, I didn't understand this at all. I thought to be a good property investor, property developer as I was in those early days too, it was about your knowledge. And in fact, I was wrong. Because I then realized that many intelligent people, many academics, many people who knew more about me, many of the property researchers, the demographers, they weren't rich. They didn't buy properties. And others who actually tried it, they lost their money as well. Along the way, I learned the power of personal development, of personal growth. And I learned from my early mentors, when I got mentors, that for things to change, you need to change. So I realized that it wasn't innate or knowledge, something that you had inside you that made you rich. It was actually something different than what I thought, I guess, inside you. It was your mindset, having rich habits. In fact, as you say, I've written a lot about it. My book, Rich Habits, Poor Habits, one I'm very proud of. I've recognized that, sure, you need knowledge. Sure, you need to be financially literate. You've got to understand how the system of finance and tax and the economy works if you want to become rich through property. There's lots of people who've got this knowledge, Brett, who don't actually use it to their fullest because they don't have the right mindset. And it's not metaphysical. It's not mumbo jumbo. I know a lot of people think that's it and that's all they need. No, if I could spend more time reading, writing, talking about hotspots or other things, I'd do that. But that's what people do when they don't really understand what the real thing is. It comes from the things you've heard as a child, the things you've learned as a child. Your financial thermostat is set for a particular level financially, and unless you change it, you'll never become wealthy. And if you suddenly do get a windfall by buying a good property, by having success, by winning the lottery, you're going to lose it. And Brett had suggested that most of your habits are formed in the first 9 years of your life. So now when you're older, 80-90% of what you're doing the same thing every day at an unconscious, as a subconscious level. Rational people act irrationally around money. We're all driving around with one foot on the accelerator and one on the brake. You've got empowering beliefs and disempowering beliefs. And that's why I called that book Rich Habits, Poor Habits. And in Australia, in today's Western society, we all have the ability to become wealthy. We all have the ability to become successful. Here in Australia, we're so lucky. Everyone you meet, Brett, and I know something more about some area of life than you and I do. So these people have got the ability to do really well in their chosen field. They just have to develop the right mindset, develop the right habits, Brett.
Yeah, so how do you develop the right habits, Michael, to become successful? There's so much uncertainty around when we worry about financial stress. It's such a big part of people's lives today. How do you make that mind shift change?
That's interesting. It's a good question because how do you become more successful? You measure it in different ways, and what success to some people isn't success to others. In my mind, true wealth has a lot more to do with other things than just money. But I know at the moment we're talking about money, and in this podcast we talk about money. So it took me a long time to realize, though, that rich people are really poor because all they've got is money. Wealthy people, on the other hand, have got a lot more than money. They've got their health, because having all this money and being in a hospital bed doesn't help you any. They've got their family and friends, somebody that they love and that loves them. They've got the ability to keep learning and growing. So true wealth to me is money plus the ability to do these things, plus the ability to give back to the community. So true wealth, in my mind, is a lot more than money. So how do you develop the right habits, which is your question? Well, first of all, you've got to understand what you want out of life. And to be successful, you've got to actually be successful inside as well. So a lot of people look successful from the outside, but once you dig deeper, they're not. So the first thing, I think, to get the right mindset, to move to the next level, to become more successful, is take stock of where you are now. Where are you now? Where are you in your life? Are you where you hoped to be? Because if you're honest with yourself, you're going to realize that you are where you are because of all the things you've chosen to do and all the things you've chosen not to do. And so don't blame the government and don't blame your parents and don't blame the education system. I know when I let go of the blame, and I did for the first half of my life, blame others and didn't get me anywhere. It actually got me into more trouble than it got me into good. When I recognized everything I'd done was for my own fault, things changed. So first step is to understand where you are, and that you are where you are because of what you've done. And then if you want to be somewhere different, you're going to have to do different things. Otherwise, you'd already be there. So you've got to recognize these habits, the disempowering beliefs that you've got, and then you've got to replace them with some good habits, some empowering beliefs. And in my book, Rich Habits, Poor Habits, I've gone through a whole lot of them. In my blogs and podcasts, I discuss them regularly in my mentorship sessions. Having said that, you don't have to change them all. You just got to change a few. And the other big thing, Brett, is you actually got to hang around the right people, positive people, people who inspire you, people who push you rather than negative people.
Yeah, great. Look, so how do you cope when things don't go your way, the way you expected to? How do you cope when things go wrong?
Well, that's an interesting lesson because success looks easy from the outside, but it's not. Things do go wrong. And what they don't write about a lot is all the failures and all the hardship and all the things you've got to go through to get there. And you know what? You're allowed to feel bad for a short time. Life isn't kind. Things do go wrong. Relationships go wrong. Businesses go wrong. The system isn't fair. The government doesn't look after you. So when things go wrong, I've learned you're allowed to feel bad for a short period of time. But many years ago, I learned about another concept, and it was the concept of having a useful belief. Things go wrong, and when they do, it's really useful to have a belief to say that this has happened for a reason. Now, you don't always know why, but the importance is to understand, well, what can I get out of this? Now, I remember a couple of years ago, and you'll know I'm talking about an important staff member in one of our offices, wasn't where you are, decided to get out, go on his own, go out in competition with us. And I thought it was a terrible time for Metropole. I thought I was disappointed. I was actually hurt by this person who I'd nurtured, I'd mentored. I was offended. Having said that, I had to come up with a useful belief. So I believed it happened for a reason, because for me to move forward, it gave me the power to say, well, what's the reason for this? And it allowed me to get somebody better who became a much better team member, who's grown our business significantly, who's added more value to our clients, our customers. And so when things go wrong, I don't let myself sulk for too long. I'm allowed to feel sorry for a short period of time. I'm allowed to feel bad. And then I've got to find a useful belief out of it. Well, what can I do out of this, Brett?
Interesting, yeah. Michael, in your opinion, what's the secret to success?
Well, it actually maybe follows on from what we just said, that successful people have failed a lot. I know I've become successful because I've failed more often than most people have. Maybe it's because I'm older, but I failed in my personal life. I ruined my first marriage. I've failed. I made lots of business mistakes. I haven't failed in business, but I've made mistakes. I've made investment mistakes, probably not as many in the last 10, 15 years as I did before. But that's one of the things that successful people do. They get it wrong. They fail. They get up one more time. So successful people have failed more often than unsuccessful people over the years. Because if you fail, in my mind, it's a sign that you're actually trying. While some people don't give it a go, they don't take action. And so therefore they're not successful. So the secret to success is to have a goal, to take action, to know that it's not going to work out, and to have resilience or grit to get up one more time than everyone else.
So let's get back to property, Michael. You mentioned before that having an investment strategy is paramount. What's your property investment strategy?
Well, the strategy we've fine-tuned and honed at Metropole, and that all our property strategists now share with our clients, is a top-down approach. We actually look at the beginning to see which areas are going to outperform. So we look at the macro level first and drill down to the micro, and then we choose a property using my six-stranded strategic approach. So the top-down approach basically means where is the economy and the demographics and the jobs growth and the wages growth going to be over the next years, not days or weeks, medium to long term, to encourage people to move in, people with higher wages, higher disposable incomes. So they're the sort of people who are not necessarily going to invest in those areas, but buy homes in those areas. So we look for areas where home buyers, predominantly occupied by home buyers who can afford to and are prepared to pay more for their properties, buy with their hearts rather than their calculators. So in general, it's in the capital cities. Then we look at those suburbs which are going to outperform because of the demographics, and the census data gives us that information. It tells us which locations have got higher disposable income. Again, these are usually those that are gentrifying, like we spoke about a bit earlier. Then we know within each suburb there's zones, there's regions, there's areas where you'd be more comfortable living in, areas you wouldn't. So in your own suburb, you'd know that there's some locations, and not necessarily just main roads, but even there's different areas that are more leafy, they're closer to the park, closer to the amenities. Then it comes down to the right street. Some streets have always had and always will have more street appeal. Then it's the right property in that street and the right price. And the price is really down the bottom on purpose, because even in today's less exuberant market, you're not going to get huge bargains buying cheap properties. A cheap property today will almost certainly be a cheap property in 5 years' time. It's not one that's going to be in strong demand. So the sort of properties we look for are ones that have owner-occupier appeal, as I said a moment ago. I like buying below intrinsic value. So as we said earlier, we don't buy new or off the plan. We're paying such a premium. We like buying properties with a high land-to-asset ratio. Now, this doesn't mean you've got a large block of land, but one where the land component makes a significant part of the asset value. So even under a villa unit or townhouses in Melbourne and Sydney and Brisbane, as opposed to an apartment in Sydney, under one of 10 in a block, as opposed to 200 in a block where there's very little land to asset ratio. We like buying in those sort of areas that will continue to outperform the averages because of the demographics there, as I said. But then when you find the property, something special, something with a twist, something unique, something different, something scarce, something that when there's others in the area, people will gravitate to that one to buy or to rent. And again, going back into what we said before, it really has to do with buying a property to which you can add value so that you can manufacture some capital growth. Because looking at all these different ways, it puts the odds in your favour. So if one strand lets you down, you've got two others supporting your property's performance. So buying a property like this strategically takes a lot of time, takes a lot of effort, takes a lot of research, and interestingly, it takes something that most investors never attain, and that's perspective. You can do the research on the internet, you can get all the reports, but the trouble is, how do you understand the importance of the various factors? And that's something that you can't get unless you've done it for many, many years, to develop perspective to understand what makes an investment-grade property. And that's really why at Metropole we have our own buyer's agents in each state that specialise in it. In fact, only yesterday I was speaking to somebody who was an accountant who was looking to refer some clients to us, and he asked me, well, do your buyer's agents just fly into the state and look? And I said, no. They're actually the people who are on the ground who actually know the areas. He said, oh, so do you get people who love property to work as your buyer's agents. I said, no, we don't employ enthusiastic amateurs. Our buyer's agents are all licensed, experienced estate agents who've worked on the other side, know their patch backwards. And that's what people expect when they see the team at Metropole. They expect somebody who is going to bring something different to the party. Sure, they got the enthusiasm. Sure, they love property, but it's that perspective and the contacts and the knowledge.
Yeah, absolutely. And how can your team at Metropole help the listeners of the podcast?
Well, if you think about it, Brett, there's only three things you can really do with property. You can rent it, you can renovate it, you can redevelop it. And in Metropole, we help clients do all that. Sure, the property investment strategists help you become wealthy by helping you grow, protect, and pass on your wealth. To start with, we tend to do a property strategic plan, a strategic property plan with a whole lot of scenarios, some what ifs, to see where you're heading, and are you heading in the right direction, and are your plans realistic? And sometimes what we end up doing is saying, well, here, just take a $29 book. That's all they need. And actually, we don't even charge them for the book. We give it to them. Because sometimes after people have seen the property strategist, they're not in the position to do something. They just need to learn some more. Sometimes they just need the plan, the strategy, but the majority of them actually go on and use our services. And what they end up doing is using our buyer's agents to implement the strategy that the property strategist has put together. And then at times what they do is they get referred to our finance strategists or wealth advisory service, property development or property renovation service. We manage their property. So as I said, you can rent it, you can renovate it, redevelop it. At Metropole, we do all that.
Michael, I can understand if you're in a boom market, but in today's market, does one really need a buyer's agent on your side?
Brett, I believe it's even. I know that people are going to say this is a self-serving question because of our relationship and our association, but I know it's also a question people ask, and so therefore I think it's a good question. And yes, it is self-serving, but I do believe it's even more important than ever because most investors have only ever bought one or two properties in their lifetime. And they're working against agents who every week spend hours learning negotiation and tactics, how to maximize the purchase price, the sale price for their vendor. So on the other hand, the buyer's agents at Metropole have bought and sold hundreds and millions of dollars worth of property each. They're in the property market all day. They know how to negotiate. They know how to scout out a good property. And even today, they know how to scout out a bargain. So in today's property market, not every property is an investment grade property. We believe it's probably a bit less than 5%. So most properties that people buy are not what we call investment grade. And so it's too hard doing this without an agent on your side. We find our clients good long-term investments. We find them those properties with a twist. We find properties with an upside potential, as I said, through renovations or development. And by doing this, it already adds instant value. Another thing is a lot of investors look for the next big thing. But if you understand some of the concepts we've discussed today, you don't have to look for the next big thing. You don't have to look for the next hotspot. If you're able to ferret out a good property in a strong location, one that's always done well, not looking for the next big thing, not what's working now. We look at things that have always worked. That's where we've seen, well, you asked me before, Brett, one of the big mistakes is chasing fads. This is working now. This is the latest trend. We actually will find opportunities in areas that have always done well. It's not speculating by doing it that way. We may miss a little bit of short-term growth, but it actually means that our clients get good long-term benefits. And opportunities like we're getting only come around a couple of times every couple of decades, where now there's a flatter period in the market, time to get in Sydney and Melbourne. And in Brisbane, it's time to move forward. It's actually, after a long lag, things are looking up as we've spoken before. So I guess the next step really is take advantage of this buyer's market.
All right, Michael, look, that's been really, really interesting. I've certainly followed this information for a long time now, and it certainly made a lot of sense to me. And as a beginning investor and an intermediate investor, I think there's something in there for everyone. So thank you very much for taking the time and sharing your thoughts. And I'm certain that everyone will find that very beneficial.
It's been real fun. I love talking about me, Brett. Why wouldn't I?
Absolutely.
Thank you. I started off the show by explaining how I'm grateful for so many things in my life. And one of the things I'm grateful for are the fantastic reviews that keep getting left about the Michael Yardney podcast on iTunes and all the other podcast apps. So thank you, and please tell others about the show as well. Just use the little share button at the bottom of whatever podcast app you've got and tell others about it, because just like I'm trying to help you, I'd like you to educate people as well about money, about property, about success. And thanks for leaving the reviews. And when I read them out, if you email me at michael@metropole.com.au, I'll give you one of my books. Just tell me which one you want. And this was left by somebody called Cat Lover and Mum, and I'm a cat lover too. In fact, Bentley's just walked over my keyboard as I was recording this just a moment ago. Bentley's one of my cats. We got two. We got Bentley and Harley. And there's Peanut Brandy who said, I found this podcast after going to one of Michael's seminars, and it's always amazing content and great interviews, especially for those looking to invest and that are already investing and need guidance. Keep up the good work. Well, thanks, Peanut. And I intend to, and you're going to get these podcasts every Tuesday. They come out, and once a month, the ones I do together with Tom Cooley on our rich habits, poor habits topics. Thanks once again for joining me this week, and I look forward to spending time with you throughout 2019.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property advice. If you got value from today's show, we'd really appreciate it if you would leave a review, and we'll read it out on a future show, and Michael will gift you one of his books as a way of saying thank you. Just go to michaelyardneypodcast.com/review and let us know what you think. If you don't already subscribe, head over to iTunes or your favourite Android app. You'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes, head across to michaelyardneypodcast.com. Watch out for our show next week. You'll learn some new ideas about property investment, success and money in around 30 minutes.